Good morning, students. Welcome back to the session on Ind AS. Today we plan to start with the topic on provisions, contingent assets, contingent liabilities. That means Ind AS 37. I would say it's a very simple topic, but very relevant in terms of its application. Because if we talk about any organization, be it of any size, this is generally applicable on them, because there are a lot of provisions of this Ind AS which you would get to see in the normal course, and it's widely used. Before we get on to this Ind AS 37, we must also understand that there is an accounting standard available under Indian GAAP, and that is also largely aligned to the standard. When I say largely aligned, means there are certain differences, but the differences are very few. So this will only help you, because accounting standard is something that you have already covered. And because of this accounting standard that you have already covered. So I was just talking about the accounting standard, and this accounting standard that we have under Indian GAAP is largely aligned to Ind AS. So a lot of concepts that we would cover under Ind AS 37, we will find that those are very similar to what we can see in case of Indian GAAP. So idea is to just align so that whatever understanding you have obtained in terms of accounting standards and also at internal level which you would have covered, that will only help you to add on to this. Alright. Now, moving on to Ind AS 37, there are three things broadly which we need to cover in this: provisions, contingent liabilities, and contingent assets. First of all, let us try to understand very broadly what do we mean by provision. And for this, we need to understand the meaning of liability. Now, in terms of in simple terms, if we have to understand what is a liability, we can say is an obligation which an issuer cannot avoid. Correct? An obligation which an issuer cannot avoid, and which is also fixed, or you can say certain in terms of its timing as well as the amount. So both the things are fixed over there. However, if we talk about a provision is something which we can say is also a liability, but wherein the timing is not certain, or you can say the amount is not really fixed. That is how we broadly differentiate between these two. And because of this difference which arises between a liability and provision, there are a lot of transactions which we need to now recognize, which otherwise would skip recognition in terms of the financial statements. Okay. So before we get on to this detailed understanding of provision vis-a-vis liability, let us quickly understand some of the scoping requirements of the standard. This standard excludes certain transactions from its scope. And let's look at those transactions which are excluded from its scope. Just 1 minute. Yes, these are some of the things which are excluded from the standard. And as we talked about provision is something wherein we can say it's similar to a liability, but wherein the timing or the amount is not certain. Now, if we talk about the scoping requirements, this standard talks about certain contracts which are called as executory contracts. And this standard doesn't apply to those executory contracts. So let us try to understand what do we mean by those executory contracts. I would suggest all of you to start referring to the study material now. Yeah. because we'll also pick up some examples from the study material. So I would suggest if all of you can go to page number 9.86 of the study material. So let's try to understand about the meaning of executory contracts. Now, what is an executory contract? Executory contract, as the terminology also suggests, it's a contract which is executory in nature. Means wherein two conditions have to be fulfilled. First, the parties to the contract. So there will be two parties to the contract, party A and party B. Both of them have not fulfilled their obligation. Number one. Secondly, both the parties have either partially fulfilled their obligations and those are equal. Both the parties have partially fulfilled their obligations and those are equal. So let's take some examples to understand the meaning of this executory contract, and I'll pick up this example from the study material only. Example number 1. On the same page, we can refer example number 1. On 1st of April 2002, Company XYZ Limited enters into a contract with Company PQR Limited for manufacture and delivery of 200 units of component at 5 different dates in future. So there is a contract between XYZ and PQR. Okay, so these are the two parties and 200 units are required to be manufactured and delivered. Okay. Now, there are 5 locations. 200 units per location are required to be delivered. On 1st of April 2002, contract between XYZ and PQR is executory. We would say this is executory in nature. Why? Because this contract is just signed between the two parties. It's in process. None of the party has performed this obligation because one party is required to deliver the component, other party is required to make the payment. Both the things are not done. So that's why what do we call it as executory contract. Now in case of an executory contract, Ind AS 37 doesn't occur. Correct? Okay. Now, as we move further, so we talked about 1st April 2002. So, no performance obligation fulfilled. So, what do we call it as? Executory contract, on which Ind AS 37 will not apply. Understood? Now we move on to the next date, 1st June 2002. So let's see what all has been done on this date. XYZ Limited has produced and delivered 400 of the units, and Company PQR Limited has paid in full for 400 units. Now what has happened? 400 units are delivered by XYZ to PQR. And in return, PQR has also paid for 400 units. Payment is done. Now in this case, contract between XYZ and PQR is still going on. It's not completed, correct? Because when would this get completed? When all the units will be delivered, which is not yet done. So can we say this contract is completed? No. Can we say performance obligations are fulfilled 100%? No. It's partially fulfilled. Secondly, what do we see? Both the parties have completed, they performed their obligations to an equal extent. Why? Because when XYZ delivered 400 units, PQR also paid for 400 units. So they have fulfilled their obligations equally. Now, even in this scenario, this contract will be called as executory contract. This contract will still be called as executory. Why? Because it's partially fulfilled and parties have completed their obligations in an equal manner. Okay. Now, can we apply Ind AS 37 on this state? No. Ind AS 37 will not apply on this date also. Okay, yeah. Now moving further on to 1st September 2002. XYZ has produced and delivered full 1000 units. Now 1000 units are gone out. So XYZ has fulfilled its obligations 100%. But PQR has paid only for 800 units. Payment is gone out for 800 units only. Okay. Now, can we say this contract is executory in nature? This is executory contract now. Let's try to understand. Now, on this day, one thing is for sure that this contract is not completed. Why? This contract is still going on. Because 100% performance obligations are not completed by both the parties. So that's why it's in process, number one. Secondly, we need to understand about the performance obligations of both the parties. Are those equal now? So let's try to understand. Both the parties have not performed their obligations in an equal manner. Why? Because one party has fulfilled its obligations 100%, but the other party has not matched up to the obligations which are fulfilled by XYZ. Correct? So therefore, in this situation, this contract will no longer remain executed. Now this will not be called as executory contract. Yeah? And in this scenario, this company PQR, let's try to understand what is the accounting that will be required on the part of this company PQR. This company PQR, because it has received 1000 units, but it has paid for only 800 units. So 200 units for which the payment is not yet made by PQR. PQR will have to record a liability for those 200 units. Correct? PQR will have to record a liability for those 200 units also, even though the payment is not made, because recognition of liability is not really dependent on the payment. Correct? Yeah. So this is the stage when this contract will move out of the purview of executory contract. Okay. Clear on the meaning of executory contract? If you have any questions, doubts. Ayush is asking about executory contract as per Ind AS 115. No. So this is something which is defined over here and which is excluded from the scope of this step. Okay. Any questions, any thoughts? If you have, please let me know. Vijay is asking, not equally completed in September. Yes, that's right. Because one party has fulfilled its obligations 100%, other party has not fulfilled its obligations 100%. So that's why it's not equal anymore. Equal means in terms of both the parties, it's not equal. So that's why it is not an executory contract anymore. Sometimes questions are also asked on the executory contract. So that's why you need to have an understanding of this. Even though this is excluded from Ind AS 37, but still this has been discussed. So you need to understand. Because when in the exam you'll be required to apply Ind AS 37, you'll have to first of all assess whether the contract is executory or not. Because in case it happens to be executory, then you will not be able to apply Ind AS 37. Okay. Yeah. All right. So moving further. Meaning of provisions, contingent liabilities, all of these things is what we need to understand in detail. All of you have covered financial instruments. Is that correct? I can see some of your queries. Onerous, etc. is something which we'll talk about in the later part of this discussion. Jamie is asking if the part payment is made in upfront at the time of signing and the other party is yet to perform. So there again, this will not be executed. Sagar is asking what's the logic behind this equal extent. The logic is very simple, to define some types of contracts on which Ind AS 37 can apply. That's it. Then Shalika is asking when we call Ind AS 37 is applicable in regarding to our cases. That is what we are discussing now. So as we'll understand about the meaning of provisions, about the meaning of contingent liabilities, you'll all understand as to when this needs to be applied. And even if you are not very clear in terms of the meaning of executory contract, don't worry, because the more you will understand about provisions, the more clarity you will have in terms of not really applying that to any executory contract. Okay. Sagar, I think I answered your query. All right. So now moving further on to provision. Provision, though we have broadly talked about what is a provision. But for better understanding of provision, we need to understand the meaning of liability. So what is a liability? Liability is something which is very, very clear to us. It's a present obligation that arises from past events and whose settlement will require outflow of certain resources. Present obligation arising from past events and will involve outflow of resources. Correct. So this is how we define a liability. Yeah. In terms of liability, as I was talking about financial instruments, under Ind AS 32, you would have already understood the meaning of financial liability. What was financial liability? Wherein the outflow of resources, or you can say in very simple terms, wherein the payment of cash cannot be avoided. Correct? Now, applying the same logic to any liability, what do we need? we need an obligation. Obligation which cannot be avoided. So that means because of an obligation, if a payment is required to be made, or in other words, if we have to say that because of an obligation, we cannot avoid making the payment, so that will result in a liability. Yeah. Now let's try to understand what are those obligations, or what could be the types of obligations because of which this outflow will happen, or because of which we can say the outflow cannot be avoided. So there are two types of obligations which have been discussed under this standard. One is legal. Second is constructive. Yes, these are the types of obligations. So let's understand the meaning of legal obligation now. What do we mean by legal obligation? Because of which outflow cannot be avoided. Okay. Let's suppose there is a contract between two parties, party A and party B. It's a signed contract between two parties, and the contract requires providing certain services by A to B. So, in a contract, A will provide certain services to B. It's a contract for 5 years. It's a contract for 5 years. Okay? None of the party can cancel this contract for a period of 5 years. Okay? None of the party can cancel this contract for 5 years. And if the contract is cancelled, if there is a breach of any condition of this contract, then a penalty is levied on this, which cannot be avoided. Again, that is driven by the contract. It's specified in the contract that this is the amount which will have to be paid necessarily. Now, this contract is legally bound on both the parties. Yes or no? This contract is legally bound on both the parties. Both A and B are now bound because of this contract. And there is a law which is governing this contract, because of which there is an obligation on both the parties. You can say the obligation is not really to make the payment, but the obligation is to perform or to deliver the service and to make the payment. If there is a breach of this contract, then the payment is required to be made, even though the contract doesn't exist anymore. So, what do we call this type of obligation as? This obligation arises because of contract, or you can say which is legal in nature. Yeah, parties are bound. Why? Because of a legal clause which is attached. Yeah. So that type of obligation is called as legal obligation. So this arises due to a contract. Okay. Now let's try to understand the meaning of constructive obligation, and then we'll differentiate between these two, legal and constructive. So far, whenever we have understood anything, means in the normal course, in business parlance, there are a lot of things which you would have covered, a lot of things which you would have understood. Every time, whenever we see or whenever we understand that an obligation is created, that has all been because of existence of a contract or because of any law which will bind both the parties. But now, under Ind AS, this obligation goes beyond the legal obligation. Means at times it may also happen that there is no contract between two parties, A and B, or you can say between various parties, or between various persons who become party to each other, but still an obligation may arise. Let's try to understand how will that obligation arise. Okay. So let's pick up this example number 3. Please go to example number 3 on page 9.88. Let's read this example. XYZ Limited is engaged in the business of manufacture of fertilizers. Effluents discharged in the manufacturing process have polluted the river near the manufacturing plant. So there is a river near the manufacturing plant, and this river is getting polluted. Why? Because of the production which has been carried out by by X Limited. The residents of the nearby locality launched a massive agitation against the pollution of the river. X Limited agreed to the demands of the residents to reduce the water pollution by installing necessary effluent treatment plant. However, during the financial year, so which financial year is this? Now, during the financial year, let's suppose if we are talking about during the financial year 2020-21. There are two parties now, X Limited and residents. Between these two persons, there is an understanding. If you will see, there is no contract, there is no signed contract between residents and X Limited. There is an understanding. What was the understanding? That X Limited will start reducing the water pollution. How? By installing a effluent treatment plant. However, during this financial year 2021, no steps were taken to install the plant. No legislature requiring the company to reduce its pollution is in existence. So we can say currently there is no legislation because of which XYZ Limited is bound to install the plant. In this case, though there is no law, but by promising to take the steps to reduce the pollution, what has XYZ done? XYZ has created an expectation towards the residents, or you can say in the minds of the residents. Now, this expectation is what? This expectation is nothing but a constructive obligation. Why? Because it's an obligation which X Limited will have to fulfill, and which will require outflow of resources. So this expectation which has been created through the promise of X Limited to the residents will be called as constructive obligation on the part of X Limited. And Ind AS 37 requires recognition of this sort of liability which will arise because of constructive obligation also. Even though there is no legal obligation, still an amount will have to be recognized in the books of X Limited. Why? Because there is a constructive obligation. But yes, of course, we need to understand properly whether the constructive obligation has really arisen or not. If the constructive obligation has arisen, then the liability will have to be recorded for that constructive obligation also. Okay. Yeah. So now, in this standard, these are two types of obligations which will be applied at multiple cases. And this is something which is about a change in mindset, because many of you will be familiar with this type of obligation, legal obligation. But I'm sure there will be few who don't really know about constructive obligation, who may not have understood about constructive obligation or learned about it as yet. So that's why this is something which is new to you, and this is something which is very, very important. And there are a lot of liabilities which get recorded in the financial statements now because of this constructive obligation which didn't exist earlier. Okay, clear on this? Yeah, clear on this? Any questions, any doubts in case you have on this? Vijay is asking, when both the parties equally participating, then executory contract? Yes, that's correct. Well, I need to understand about all those things. Huh? Don't worry. Sagar, I'm hoping you are clear on this now. Okay, anything on the legal obligation, constructive obligation? Now, talking about provision. So basically, we started with provision, but we moved on to liability, and then we moved on to these two types of obligations. So let's understand what is a provision. Provision, we can say, is nothing but a liability. Nothing but a liability, wherein the liability doesn't have certain time or amount. So liability with uncertain timing or amount. So in case we get to see a liability, but we are not certain in terms of the amount, we are not certain in terms of the timing. Timing as regards the outflow. That is something which we call as provision. Okay, so Vijay is asking, sir, do we create in the books, do we create a liability for constructive obligation in the books, or only it's closed? This is something which will be recognized. So we will have to recognize. It's not a disclosure which I have been discussing. Manan is asking, CSR is constructive. See, CSR is not really constructive anymore, because CSR is not driven by law. Law mandates CSR in certain cases, depending on the criteria which is fulfilled. But yes, of course, at times this can also become constructive, provided it's not mandated. But CSR now we get to see is mandated. Okay. Yeah. All right. So now moving further, as we talked about uncertainty in terms of timing, uncertainty in terms of amount, this is how we need to differentiate provisions from liabilities. But there's a very narrow difference, and at times it becomes very, very difficult to differentiate between these two. So that's why more and more examples will discuss, more and more clarity will get. Now, let's pick a few examples. Trade payables. Trade payables means, for example, sundry creditors. What are sundry creditors? Sundry creditors we get because let's suppose we have purchased certain goods, we are required to make the payment to the vendors. So there's a liability towards sundry creditors. There's a liability towards vendors, which is nothing but a trade paper. Or let's suppose we have obtained services of the employees to whom the payments are required to be made. So that is again a liability, or you can say trade paper for the employees, towards the employees or towards the services. Now, if we look at these trade papers, what are these? These are liabilities. These are liabilities towards goods or services which an entity would have received. Similarly, there is a concept which is called as accruals. And all of you can just refer to this page number 9.90. I have been picking up all of these examples from here. There's a concept of accruals. What are accruals? Accruals again are the liabilities to pay for goods or services that have been received, but against which, let's suppose, invoice has not been received. Okay. At the year end, we create accruals. Yeah. Now, if we have to understand the provision, then we need to appreciate the differences between these things. Liabilities and accruals in these two scenarios which I have discussed with you will not become provision. Those are different from provisions. For example, if we talk about amounts related to accrued vacation pay, so this is not a provision. And I think this can be best understood with the help of this table, which is given on page number 9.9. So all of you please refer to this table. It will help us understand the differences of all of this. If we talk about certain liabilities which are required to be cleared, for example, utility bills, say for electricity, for water, etc. Can we say it's a provision? The answer is no. Why? Because these are something which is in the nature of a liability. Why? Because for a provision, some uncertainty has to be there, either in relation to timing or in relation to amount. So let's take an example of bill of electricity. Now in this case, even though the bill has not been received, still the timing of payment is known. Why? Because the utility companies would have fixed the dates on a monthly basis or maybe on a regular basis as to when the payments are required to be made out. Secondly, as regards the amount, means as regards the measurement, here again a reliable estimate can be made. It's not difficult to make an estimate in terms of the amount which is required to be paid. So that's why this uncertainty we don't see in case of utilities. So that's why we will not call it as provision. We will call it as accrual. Number two, let's suppose an entity has received goods, but the invoice for the goods has not been received for some reason. Now here again, because the goods have been received, so there must be an understanding between the entity and the vendor as regards the timing of the payment, because there is something which is pre-agreed either because of contract or because of purchase order. This understanding would have been clear. So the timing is clear. Secondly, as regards the amount, because the goods have been received, so the rate must be known to two parties as to the amount at which the goods would be received, or the quantity of the goods, that is again known to us. So that's why in this situation, can we say that the amount will be uncertain? No. So here again, even though the invoice is not received, can we say for these goods which have been received without invoice, provision should be recognized? No. It's not a provision, it's a liability. Third, financial guarantees. Now we understand that the financial guarantees are required to be recorded. And those are required to be recorded in the books of accounts as per the requirements of Ind AS 109. This is something which doesn't arise under Ind AS 37. Which standard deals with this? Ind AS 109. Now, because there's a separate standard dealing with this, so can we get it covered under Ind AS 37? No. So that is also scoped out. Now, let's pick up another example of warranty. So what is a warranty? Let's suppose we have purchased certain goods and the goods come with warranty. Some goods are purchased with a warranty. XYZ is referred to names. Goods are delivered. Okay, payment is made. Now these goods carry a warranty period of say 3 years. Okay, this carry a warranty of 3 years. Now in this scenario, there is an obligation on the part of XYZ. What is this obligation? Very clearly, this is a legal obligation. Why? Because there is a contract between these two parties. And because of this legal obligation, for a period of 3 years, if there is any problem with these goods or the product which XYZ would have sold to ABC, XYZ would be required to make good that product for ABC. Yeah, because of this arrangement between two parties. Yeah. Now let's try to understand about this obligation which arises on on XYZ. Now, first of all, let's think about the timing. Can XYZ today, when the product is delivered or sold out, know with certainty? With this certainty, can XYZ know at what time this warranty obligation would arise on this? All of you, quickly, over to you. What do you think? Will it be possible? Or do you think it will be possible on the part of XYZ to know with certainty the timing as to when the product may go defective, which would be required to make good by XYZ? Quickly, over to you, all of you. Please answer this. What do you think? Can this be known? Jamie, I'll cut to your query. If all of you can answer my question, please. Do you think it will be possible on the part of XYZ to know about the time when this obligation would arise on XYZ? Lisa is saying no. What about others? Shalika is also saying no certainty is there. Parag is asking about expected constructive obligation. I'll come to that later, please. Maybe towards that time of discussion. Okay, great. So Surya is saying no, Kalyani is saying no, Navneet is saying not possible. Pranav is saying based on past events, they can estimate the period and the amount of warranty. Not really. Based on the past events, XYZ knows that warranty obligation will arise. But XYZ will not know when will the warranty obligation arise. This warranty, let's suppose one product is sold out. Now, at what point of time that may become defective? Maybe on this date, this date. It's not known to XYZ at all, isn't it? Though past history may indicate that whenever the goods are delivered, out of 10, 2 become defective on an average. That past, or you can say the historical pattern can give some indication to XYZ. But as regards to timing, can that really be certain? No, not possible. Correct? So that's why what is the first thing that we see in case of warranty? The timing is uncertain. Okay, let's talk about the amount. So I received some more responses. Radha, Vijay, Jamin, Praveen, Kushni, they are saying no. Wait, Shirajni is also saying no. Not possible to know as to the timing. Very good. Okay, now let's talk about the amount. So on timing, we are clear that there is no certainty. It's uncertain. Let's think about the amount. Can we say that the amount is something which XYZ today will know with certainty? Again, it seems to be very difficult. Why? Because if XYZ is not certain about the timing, how can the amount be certain? Let's suppose XYZ has sold 100 goods. Now, out of 100 goods, XYZ can only take an estimate, which is only an approximate, that out of 100 goods, say 8 goods will go defective and will come for repairs. Correct? Now this number may be 8, this may be 18, this may be 28, this may be 2, for which XYZ will have some historical pattern. XYZ will have some historical pattern. But can we again say that in future warranty will only arise based on the historical pattern? No. Because maybe this is slight change in technology of the products which were delivered this time, and because of which they may not go defective. Correct? At the same rate at which those were getting defective in the past. Or maybe now the defective rate may become higher. It can be either. And depending on the number of cases that will arise, what will happen? The outflow will increase because more and more goods will come back for repair. The more and more amount will be required to be spent. Right? Yeah. So definitely an estimate will have to be made. There's no doubt about it. But can we now say that the amount is certain? Like we had when the goods were getting purchased. We knew that 100 quantities have been purchased at this rate. So do we have that certainty? No. Tejal is saying no. Radha is saying no. Correct? Yeah. So would we see that the amount is also uncertain? Now let's try to differentiate this one with utility bills, with purchase of goods, we see a lot of uncertainty involved in case of warranty. A lot of uncertainty. Yeah. And because of this uncertainty, even though we know that there could be an obligation, there is definitely an obligation, which may result because of past event, and which will involve outflow of resources. So all these three things are there. All these three things are there. The only thing which gets added to these three things is the uncertainty. Now, because of this uncertainty, what will happen? Instead of creating a liability in the financial statements, we will create a provision in the financial statements. Okay. And the provision which will create in the financial statements will be as per Ind AS 37. Yeah, clear on this? This will be as per Ind AS 37. We are clear on the meaning of provision, on the meaning of liabilities. Difference between these two is very, very important to understand both of them. If you have any questions, any doubts around any of these items, please let me know. Yes, I am waiting for your queries if you have any. Then we'll start picking up examples to understand the recognition of provision. So the meaning of provision is clear. Yeah, so we'll now move on to understand as to how this provision is required to be recognized. So Vijay is asking, for utility, timing is certain, but amount might change little, but that is very little, minuscule. But if you look at warranty, you can see the significance in terms of the changes which may arise. Yeah, so that's why utility will also not be an actual liability, this will also be an accrual. And that's why I said there are three things which you get to see: liability, accrual, and a provision. Alright? Alright, so moving further on to recognition. So we'll now start understanding the recognition of a provision. If all of you can move on to illustration number 1 on page number 9.93. ABC Limited, oh sorry, I see few queries. Namita is asking about the liability. So the liability is the one which involves outflow, wherein the timing is certain and the amount is also certain. As compared to which, in case of provision, outflow has to happen for sure because of past events, but we don't know what will the amount. With certainty, we don't know when this outflow will be required to take place. Okay, so that's the difference, and that is how you need to understand about the meaning of liability. Okay, Jamin is asking, correct me if I'm wrong. Timing is uncertain amount. Timing is uncertain, amount is certain. This is a provision. Timing is certain, amount is uncertain, this is also correct. So the moment there is an uncertainty, you will not be able to record a liability, but you will have to record a provision, and which will be as per Ind AS 37. Okay. Any more questions? Alright, so moving on to this illustration number 1 now. ABC is automobile component manufacturer. The automobile manufacturer has specified a delivery schedule, non-adherence to which will entail a penalty. As on 31st March 2001, the manufacturer has a delivery scheduled for June 2002. So we are on 31st March 2001 and there's a delivery which is scheduled for June 2002. It is scheduled for this date. However, the manufacturer is aware that we will not be able to meet the delivery scheduled in June 2002. So there will be a default. This is something which is known on this date to the manufacturer. Who is the manufacturer? Means ABC knows about it. That this will get delayed. Okay. Determine in this scenario whether entity means ABC has a present obligation requiring recognition of a provision. Okay. Yeah. Namita and Meena, I think you will get more clarity with the help of this example. Meena is asking, means any of the criteria from amount or timing, if that goes uncertain, it will be a provision? Yes, that's correct. Now in this case, let's try to understand. There is no present obligation arising as a result of past event. Why? Because it's a future delivery. It's a delivery which has to take place in future, in June 2002. As on 31st March 2001, do we see any delay? No. So can, in the given case, we say there is a present obligation? No. There is no present obligation. So there are two scenarios which are possible, but on the basis of facts, it's only one scenario. It's only one scenario. So I'll also add one more scenario to this. Scenario 1. As per the terms of the contract, ABC is required to deliver on June 2002. Today, ABC knows it will get delayed. But when would this delay happen? In June. In June, this delay would happen. Today, on 31st March X1, because of this delay which will happen in future, is there any penalty on ABC? No. There is no penalty on ABC today which arises. Yes or no? Penalty may arise on ABC. Penalty may arise on ABC. But when will that penalty arise? In June 2002. When there will be a delay. So, will there be any penalty? No. So, can we say, looking at 31st March 2001, any outflow is expected on the part of ABC? No. No outflow is expected. If no outflow is expected, so do we need to create a provision? The answer is no. There is no need to create a provision. Why? Because for a provision, there has to be an obligation, and which must result in outflow. That outflow may be uncertain in terms of its timing, may be uncertain in terms of determination of amount, but outflow must be there. But outflow must be there. In the given scenario, outflow doesn't exist. Okay? So therefore, in our question, no provision will be recognized. Yeah? Let's move on to scenario number 2. Let's suppose there is an understanding between the parties wherein ABC is required to deliver the schedule, for which some work should have started by 1st March 2021. Some work. Now, what is that work? We are not getting into that work. Okay. Some work should have started. And if that work doesn't start, then it is for sure that this delivery target would not be met. Okay. So there are two things which are required to be met. One, delivery on this date. One is delivery on this date. Second is initiating this process on this. Initiating the process on this date. Okay. Now we know that on this date, no process has been initiated. And if this process doesn't get initiated, then the delivery is bound to get delayed. And if there is a delay, penalty would be levied. So that means we know today for sure that because of this default on the part of ABC, ABC will be subject to some penalty. Okay? So now the scenario has changed. Now there is a default which has taken place by 31st March 2021 and which will result in some penalty. In this scenario, can we say that there is a present obligation on the part of ABC? The answer is yes. Will this present obligation result in outflow? The answer is yes. Its timing, its amount may be uncertain. But in this scenario, will there be a need to create a provision? The answer is yes. Why? Because the outflow will take place, and when the outflow will take place, so the provision will have to be recognized. Okay. Namita is asking, sir, is it known on 31st March that delay would happen? So it is known that outflow will happen, which is true. But as on 31st March, there is no delay. As on 31st March, we know that delay will happen in future. We know, but we need to look at the present situation. We need to look at the obligation which arises today. Today, no obligation arises. Obligation is something which will arise in future. That's why for the scenario number 1, we don't create any provision. Clear on this? Meena, I'm hoping you're clear on this now. Pranav is asking, sir, can we say that if uncertainty is involved in a liability, then provision should be created? Yes, of course. So I'll just repeat for all of you because I can see this query coming up repeatedly. The moment we say there is a liability, In simple terms, because I'm sure all of you would know about liability. The moment we say there's a liability, but this liability has either uncertain timing or uncertain amount or uncertain timing as well as uncertain amount. Okay. In such a scenario, that liability is known as provision. Clear? Meena is asking, so this initiating the process which is defaulted on 31st of March, will this result in a penalty? Yes. That is what I have added over here. It's not there in the illustration number 1. These facts I have added. So I'm saying there's a default in initiating the process which results in a penalty. So that's why create a provision. Okay. Sharika, clear on this? Yeah. Meena, clear on this? So that's why we are saying there will be a penalty. Why? Because this activity or this obligation is not fulfilled. This is an obligation on the part of ABC to initiate the process, but it didn't do. So for not doing this, there's a penalty. So if there's a penalty, we know this has triggered on the 1st of March. So that should be recognized in the financial statements. Okay. Yes, quickly. Meena, Sharika, anyone else? If you have any questions? Okay, Navneet is asking, sir, what if delay is covered by ABC before June? So that's a separate scenario. That is something which ABC will analyze. That because of this default, will there be a penalty or not? Or is there any way to compensate for this? And that will depend on the terms of the contract. Currently, we are not saying this will be compensated. If ABC believes this will be compensated, ABC will be able to cover up the time and eventually the final delivery date will be met, and because of which there is no contractual penalty, then of course provision will not arise. So it all depends on the terms of the contract. In the given scenario, we have considered that the final delivery date will get defaulted. And in scenario number 2, we are saying there's a default which started on the 1st of March and which also invites a penalty. That's why we are creating a provision on 31st of March. Okay. Meena is asking why initiating the process leads to a penalty. The reason being, company know it gets of course. Secondly, the context suggests this. The term suggests this. The terms of the contract are so between 2 parties. Shalika is asking in scenario number 2, how do we have outflow of resources? Outflow is because there's a penalty which will get levied on ABC for not initiating this process. Okay. Then Satish Kumar is asking, can we say provision should be created as we know or we can determine the present obligation as on or up to the reporting date? Yes, of course. And Srijini is asking, can we say that obligation should compulsorily arise to recognize a provision? Obviously. Because without an obligating event, we will not have any outflow of resources. Vijay is then asking, if the question says initiating the process not commenced, then it is default. In the given scenario, the facts are such which are changed, or you can say I have added to the facts. Wherein I am saying if the process is not initiated, there is a penalty. So of course, this will invite a penalty because it's as per the contract. Okay, so that's why there's an outflow, and that's why you need to create a provision. Okay, yeah. So the meet I have understood. Okay. Navita is asking why we recognize provision. Why we recognize provision is not liability even if default arises on 31st March. This is because of the fact of the uncertainty in terms of the timing or the amount. And that's why I'm saying it all depends on the terms of the contract. Currently, the terms of the contract are that the timing of this penalty or the amount of this penalty is not really something which is certain. Clear? Okay, so moving further. We understand that this provision is something which we recognize, or liability is something which we recognize because of three things. One, there has to be a present obligation. Second, present obligation should be based on the past events. Third is the outflow of resources. Let's spend some time on the second requirement of past events. So what is this requirement of past events? What is it that we need to look into? If we talk about a warranty provision, in case of warranty, we discussed that provision will be required to be clear. Correct? But what is that past event which will result in a warranty provision? Sale of goods. Goods were sold on, say, 28th of March 2010. Yep. After which there is a warranty period of 3 years. Now, what is this past event which may trigger the warranty provision? This thing, sale of goods. Okay. Next, in case we are required to create a provision for contamination of land. You remember we discussed about polluting water, which was required to be sort of improved by installing a plant, for example. Similarly, let's suppose due to certain industrial activities, land is getting contaminated. Land is getting contaminated, and which is now required to be sort of rectified or improved upon, which is required to be made good. Now, in this case, what is the past event which will result in the provision for making good the contamination? That is about contamination. So, when the land is getting contaminated, that is the past event. So, what are the past events? These are the past events. So, we can say these are the events which have already taken place, because of which provision is going to arise. Land is already contaminated. because of which obligation arises and because of which outflow will result in future. So this is that, and this event is past. Okay. Third, in case of dismantling provision, I'm sure if you would have covered Ind AS 16, Ind AS 16, you must have heard about asset retirement obligation. And I'm sure you will remember, Ind AS 16 you have all covered. Decommissioning liability, dismantling obligation, asset retirement obligation, all of these things you would have covered, all of you. Yeah, you remember? Quickly, tell me. I'm waiting for a response. All of you quickly. Ind AS 16 is all covered. You remember decommissioning liability, dismantling obligation, asset retirement obligation. You remember about that? Great. Manan has confirmed this. Very good. She has confirmed. Now, if we talk about that decommissioning liability, let's apply the same principle over here. What is that decommissioning liability? That decommissioning liability is again a provision. And why would that arise? Because some structure is installed today, which will be required to be decommissioned in future. Let's suppose some structure is installed today. Which would be required to be decommissioned in future, and which will result in outflow of resources. Okay. So here again, what is the past event? This is the past event. Okay. So we'll now move on to some examples. You can go to page number 9.95. At times, it is possible for an entity to avoid the future expenditure through its future actions. So, for example, if a change in technology is there, change in methodology is there, through which future expenditure is avoided. That present obligation goes off. Why? Because we know that this future liability will not arise or the outflow will not take place. In such a case, provision will also not be recognized. So let's look at some examples to understand this in a better manner, because without the help of examples, we will not be able to appreciate this concept. Okay, so I am moving on to example number 10. Fitting smoke filters in a certain type of factory. Since the entity can avoid the future expenditure through its future actions, say by changing the methods of operation. It has no obligation for future expenditure. Right? Therefore, no provision will be recognized. Let's move on to example number 11. Government, let's suppose, introduces a number of changes to income tax system. As a result of these changes, an entity in the financial services sector needs to retrain a large proportion of its administrative and sales force in order to ensure continued compliance with various regulations, which have actually got changed. As at the end of the reporting period, no retraining of the staff has taken place. It is assumed that a reliable estimate can be made of any outflows expected. Now, in the given scenario, can we say that there is a present obligation? There is no obligation. Why? Because no obligating event. What was the obligating event? The retraining the staff. No obligating event has taken place. So now in this case, because this event has not taken place, so do we need to create a provision for this? The answer is no. Answer is no. Another example. Example number 12. Under new legislation, an entity is required to fit smoke filters to its factories by 30th September 2000X1. So it's the cutoff. By 30th September 2000X1, smoke filters are required to be fitted. Entity has not fitted the smoke filters. It is assumed that a reliable estimate can be made of any outflows which are expected on this day. Now, as on 31st March 2000X1, as on 31st March 2000X1, there is no obligation because there is no obligating event either for the cost of smoke filters which are required to be fitted or fines under the legislation. Why? Because what's the target date? 30th September. By what date is required to be done? 30th September. On 31st March, is there any obligation to fit any smoke filter? Is there any default on this date? So can we say there is any present obligation on this date? Therefore, on this date, do we create a provision? Okay. Moving on to 31st March 2000X2. Okay. There's still no obligation for the cost of fitting smoke filters because no obligating event has occurred. Fitting of the filters. However, an obligation might arise to pay fines or penalties under the legislation because the obligating event has occurred. That means non-compliant operation of the factory. Now, for fitting the smoke filters, by 31st March, company did not initiate any contract. So company doesn't have any contract in hand. So can we say company has a present obligation in terms of fitting the smoke filters? No. So for fitting the smoke filters, there is no present obligation. There is no liability. But one thing is for sure, that this was a regulatory requirement, and if there is any default in the same, penalty may be levied. Why? Because there were two options to the company: either to shut operations for this entire period, means this period, because up to this date it was allowed to continue without fitting the smoke filters. But after 30th September, smoke filters should have got fitted, but the company didn't do. So company had two options: either to shut operations on this date till the time these are not fitted, or if the company continues with the operations, then the operations have gone without compliance of the regulation, which will invite penalty on the part of the company. So the company opted for second thing, to continue the operations with non-compliance. So there is a penalty obligation which may arise. Correct? So assessment of probability of incurring the fines or the penalties because of this non-compliance depends on the details of the legislation and stringency of the enforcement regime. Yeah, for which an assessment will have to be made and for which provision will be required to be made. So for this fitting, no provision is required to be made because there's no activity as around this which has started. But for the penalties, provisions will have to be made. Okay. Navneet has a query. Navneet is asking, any lawsuit arises on our previous contracts will also be a contingent liability requiring provision. I think you mixed up two things, Navneet. One is contingent liability and second is provision. These two are completely different topics. Okay. So I would suggest please wait for some time. When we'll pick up contingent liability, we'll discuss about that. Okay. Meena is asking, sir, why the obligation is not arising on the part of the company as at 31st March 2022? See, why the obligation is not arising? Because obligation arises due to some act of the company. In this case, company has not acted on this. So let's suppose if the company wants to create a provision for fitting the smoke filters, when will that take place? When the company will have some estimate that this is the amount which will be required to be incurred, for which company will reach out to the vendors for fitting this. Company will have a contract with them. For this contract, company will be bound, because of which company will start getting an obligation. As on this date, company has not done anything on that front. Company has not done anything on that front. Yeah. Therefore, as regards to fitting is concerned, there is no obligation. But this is for sure that there is an obligation towards non-compliance, or because of non-compliance, an obligation arises on the part of the company which cannot be avoided. Yeah. So definitely there is an obligation, but not for fitting the smoke filters, but for penalties which will be levied on. Okay. Clear? Clear on this? Yeah. All right. So we'll pick up one more example. Example number 14. Page is 9.96. A furnace has a lining that needs to be replaced after 5 years for technical reasons. There's a furnace which has a lining that needs to be replaced every 5 years. So every 5 years, this is required to be replaced. At the end of the reporting period, the lining has been in use for 3 years. So it's been 3 years. And this is our reporting period. It is assumed that a reliable estimate can be made of any outflows expected. So can we say that there is a present obligation? The answer is no. So do we need to create a provision over here? No. Why? Because when would this get triggered? On this. Today we are on this. Okay. The cost of replacing the lining is not recognized at the end of year number 3. At the end of year number 3. Because there is no obligation to replace the line which exists on that date. Correct? Instead of provision being recognized, the depreciation of the lining takes account of its consumption. In fact, this is something which is a principle of Ind AS scheme. Ind AS 16, as you have all confirmed, we have covered, except for Kalyani, for some reason she is saying Ind AS 16 is pending. I'm not sure because all of you are saying Ind AS 16 is covered. Under Ind AS 16, there is a concept of major overhauling. You remember? Major overhauling. That if there is a major overhauling, that needs to be capitalized along with the cost of the PPE. Remember? Yeah? And that major overhauling will have its own independent life, similar to a component. So this is nothing but the same example of that component. Okay? Yeah? So what will happen? Whenever there is a refurbishment cost which will be incurred, that will be depreciated over a period of 5 years. When this will get incurred over here, then again it will be depreciated over the next 5 years. Then again over the next 5 years. So this is how this will keep going on. So no obligation therefore arises on this. Okay? All of you clear on this? Yeah, clear? Okay, great. So moving on to next example, which is of similar sort. Example number 15. An airline is required by law to overhaul. It's again the same example of major overhauls. Yeah? To overhaul its aircraft once every 3 years. It is assumed that reliable estimate can be made of any outflows expected. Now, the example which we discussed for lining or replacement of this lining was something which was not required by law. But this example number 15 requires overhauling, and this overhauling is mandatory as per the law. But will that change our understanding? No. Will that change the requirement of accounting? No. Both the things go in a similar fashion. Okay. So now what we can do is we can move on to this illustration number 2. All of you need to please pick up this illustration number 2 and start solving this on your own quickly. Illustration number 2. Page number 9.97. I know you are waiting for a break. So let's do this illustration number 2 and then we'll go for the break. X Shipping Limited is required by law to overhaul its shipping fleet once in every 3 years. The company's finance team was of the view that recognizing the cost only when paid would prevent matching of revenue earned all the time with certain costs of large amounts which are incurred occasionally. Thereby, it has formulated an accounting policy of providing in its books of accounts for the future cost of maintenance, that means overhaul or annual inspection, etc., by calculating a rate per hour sailed on sea and accumulating a provision over time. The provision is adjusted when the expenditure is actually incurred. You need to comment on this accounting policy of the company. I am sure, having done Ind AS 16 already and doing sort of revision of that today, you will be clear on this. Do you think the accounting which the company has picked up for this sort of overhaul is something which is correct? Applying the principles of Ind AS 37, Ind AS 16, or whatever you think is relevant. Can you all please comment on this quickly? I'm waiting for a response. Quickly, all of you. What do you think about this accounting treatment of the company? Please don't look at the solution of the study material. Please try to solve this on your own quickly. Without looking at the solution of the study material, please. You need to comment on this. I'm waiting for a response. Quickly. Lamita is asking, sir, please explain why in liability we are considering only present obligation. But this is the requirement of the standard. Please go back to the definition of liability, Lamita. You will look at the framework, which defines the liability. Go back to accounting standards also. Go back to the fundamental principles. Everywhere, this is how liability is defined. Liability is something which will create for present obligation only. Now, all of you, I am waiting for your answer. Rather, is saying the accounting policy is not correct in illustration number 2. Why? Because it should have been considered using the principles of Ind AS 16. So, can you tell me, Radha, what should be the correct accounting treatment? And other students, please confirm. whether this is correct or not correct. Meena is saying this is incorrect as the obligation arises from past events and can't make provision for future obligations. Okay, great. What about others? Okay. So Shri Ranjini is saying entity should not recognize the provision because entity can avoid the obligation by selling the ship. Oh, Elaine is saying to be provided for when actually incurred and then depreciated over the period of 3 years should be the correct accounting treatment. What about others? Sharika is saying in case of restoration contract, there is a certain timing of dismantling, but we create a provision for that. Yes, I'm just thinking that you're trying to link that with this one. Radha is saying this is overhauling cost and hence this should be capitalized. Okay, great. So let's go to the solution. In the given case, no provision should be recognized. Why? Because those are for the costs which are going to be incurred in future. The accounting policy, therefore, which the company currently adopts is not correct because this accounting treatment is not correct. What should be the right treatment? To follow the component accounting as per Ind AS 16, wherein if the cost is incurred for overhauling on this date, so whatever is the cost incurred, let's suppose 10 crore is the overhauling cost, that should be capitalized as a component on this date and that should be depreciated over a period of next 3 years. Then let's suppose after 3 years, once again, cost is incurred. Say now it is 20 crores. There again, it should be estimated that will the overhauling continue to be 3 years or it will change. If it continues to be 3 years, it will then be depreciated over 3 years. So this is how this will continue. Period of time. Okay? Mana is saying company should create reserve for the amount of overhauling cost, not reserve. I'm not very clear on this. Satish Kumar is saying provision created is not correct because there is no present obligation. Very good. Amina is also saying no provision should have been created. Great. So it's good that you remember the principles of Ind AS 16 and you are now able to understand and also differentiate as to how those principles of Ind AS 16 should go with the principles of Ind AS 37. Yeah? In this scenario, I can see that you are now not getting confused of requirement of provision. Why? Because if something is already dealt by Ind AS 16, that is not something you will duplicate by creating a provision at the Ind AS 37. Alright? Clear on this? Yeah? Okay, great. So now, before we move further, we can take a short break. Yeah, let's take a break for 5 to 10 minutes. After the break, we will continue with our discussion. Okay, yeah, let's take a break. In the meantime, if you have any questions, queries, please send across your queries. All right. Yes, break. Ram, can I start? Hi, welcome back. So we'll now continue with our discussion. So moving on to some more examples related to the recognition of a provision. So moving on to this example number 17. So we can move on to page number 9.98. 17. An entity in the oil industry having 31st March year end causes contamination but cleans up only when required to do so under the laws of the particular country in which it operates. One country in which it operates has had no legislation requiring cleaning up, and the entity has been contaminating land in that country for several years. As at 31st March X1, it is virtually certain that a draft law requiring the cleanup of land already contaminated will be enacted shortly after the year end. It is assumed that a reliable estimate can be made of any of the outflows for cleaning up of the land can be made. Now in this scenario, let's see what's the requirement of a provision. Do we have any past event in this case? Yes. What's the obligating event? Contamination. Yeah. Second is, we understand that there's a virtual certainty. There's a virtual certainty that law will come. As on the 1st March 2001, we know that law will be there. It's virtually certain. So will the company have any present obligation now? Of course, because of the past events, there arises a present obligation. And this amount, even if it's uncertain, still this has to be measured and this can be measured. So in the given scenario, will the provision be required to be made? Yes, the provision will be required to be made in respect of cleaning out. How the provision will be made, that is something we will move later. Okay, yeah. Okay. Similarly, we can move on to example number 19. Another example. An entity operates an offshore oil field where its licensing agreement requires it to remove the oil rig at the end of production and restore the seabed. So the company is oil producing company, and just to tell you briefly that oil producing companies extract the oil from the seabed. Yeah. So that's why they need to install an oil rig. You can say it's an equipment, or it's like kind of plant and machinery which is installed over there, and because of which deterioration of seabed takes place. Yeah, because of which seabed gets deteriorated, and after this work is completed, the seabed is required to be restored to its original condition. So an entity is operating offshore oil field. Offshore means in the sea, and it has a licensing agreement. So there's a legal obligation on the part of the entity to remove the oil rig at the end of the production and restore the seabed. 90% of the eventual costs relate to removal of oil rig and restoration of damage caused by building it, and 10% arise through extraction of it. So they are telling you the reasons as to why the cost will arise. At the end of the reporting period, rig has been constructed but no oil has been extracted. It is assumed that reliable estimate can be made of the outflows which are expected. So now in the given scenario, let's understand whether there is a need to create a provision, and if yes, how should this provision be created? So over to you quickly. I would again suggest you not to look into the solutions. Yeah? Please answer this. What do you think should be the basis of creating a provision, or do you think provision should not be created in the given scenario? Quickly. Yes, over to you. Tell me, what is your answer? Do you think provision should be created or not? If you believe provision should be created, what should be the basis of creating a provision in the given scenario? Quickly, I am waiting for a response. Quickly. Yes, tell me. Okay, Pranav is saying yes, provision should be created. Okay, great. So, what should be the basis of creating a provision, Pranav? Briefly, if you can tell me, and all others. Ashok is also saying create a provision. Okay, great. What about others? Provision to be created. Okay, Shirajini is also saying yes, it should be created. Vijay is also saying yes, it should be created. Okay, great. Now, in the given case, yes, of course, provision has to be created. Why? Because the past event. What's the past event? Construction of oil rig. Because of deterioration takes place, has already happened. And there's a legislation which requires us to restore the seabed. So deterioration has taken place, past event has taken place, present obligation has arisen, and the amount can also be measured reliably. So that's why provision will have to be created. A provision will be made of 90% of the deterioration, which arises due to construction of oil rig and not due to extraction. Why? Because extraction has not yet taken place. These costs are included as part of cost of oil rig only. 10% of the costs that arise through the extraction of oil are recognized later on when the oil extraction will take place. In fact, if you again go back to Ind AS 16, these are drawn from the principles of Ind AS 16 only. When an oil rig is getting installed over there, this is something which is a part of the cost of the oil rig only, which is nothing but a decommissioning liability only. Yeah, clear? Okay. Moving on to next example. Example number 20. After a wedding in 2000 X1, X2, just see if I can understand. Okay, so I see no responses. Meena, Kalyani, they have all answered this correctly. Sharika is also saying create a provision. Kanika, Praveen, Radha. Okay, great. Yeah. Great. So moving on to next example now. After a wedding in X1, X2, 10 people died, possibly as a result of food poisoning from drugs sold by the entity. Legal proceedings are started seeking damages from the entity, but it disputes the liability. Up to the date of approval of the financial statements for the year to 31st March X2 were issued. So we are talking about 31st March X2 financial statements. And this event took place during this year. So let's suppose up to the date of approval. So this is date of approval of financial statements. So this is 1st of July 2000. Up to this date, entity's lawyers advise that it is probable that the entity will not be found liable. Up to this date, entity has taken a view and the lawyers are saying probability is there that the liability will not arise. However, when the entity prepares the financial statements for the year ending 31st March 2003 for the next year, lawyers advise that due to the developments, it is probable that liability will arise. So on this date, lawyers' view was no liability, but on this date, lawyers have changed their view. They are saying liability will arise. Now, in the given scenario, on these 2 dates, what should be the accounting treatment in relation to this event which took place? So we can say the strong litigation which is going on. Yes. Now, if we look at 31st March X2, we need to also look at the conditions which existed up to the date of the approval of the financial statements, and by then, entity was sure in the sense there was a probability that the liability will not arise. So even though there is a past event, and because of this there is a present obligation, but that present obligation results in a liability amounting to rupees nil. So that's why do we create a provision over here? But moving on to next year, there has been a past event for which present liability or present obligation exists and for which outflow will also take place. Therefore, will the provision be created on this year? Yes. Clear? Yeah. Okay. Kanika has a query. Kanika is saying because of current obligation, say which is constructive in nature, which is arising out of past events of extraction activity. Am I alright? So I think you are talking about that oil rig example. That was not because of the constructive obligation. In oil rig example, there is legal obligation. Okay, so definitely provision will be created, but that is because of legal obligation, not constructive. Yeah, Dada is saying in this case, provision should not be created on 31st March, but on 31st March X3, provision should be created. Very good. So you can just note down your homework. Illustration number 3. You can just mark this illustration for your homework. So continuing on this recognition of provision, I'll pick up one more example. A retail store has a policy of refunding purchases by dissatisfied customers, even though it is under no legal obligation to do so. So retail store has a policy that if the customer is dissatisfied, they will take the return and they will pay the money back. its policy of making the refunds is generally known to the public. It is assumed that a reliable estimate can be made of any of the outflows expected. Now, in the given scenario, for these refunds, what do you think should be the correct accounting treatment? What do you think should be the correct accounting treatment? Kalyani has a query. Kalyani said, but in example number 20, will lawyers' advice suffice for no probability in March 2000X2? The situation clearly says that liability may arise at any point of time. Yes, definitely the liability may arise, and which company was also assuming, and that's why they reached out to lawyers, because there's a litigation which is going on, and lawyers are sure, because when you say it's probable means it's having chances of more than 50%. So when it has got chances of more than 50%, that's why company is confident, and that's why it's appropriate not to record the liability. Okay. Now, in the given situation, let's see what should be done. In the given situation, and I'm talking about example number 22 now. It's known to the public that the retail store will give the refund. Right? So an expectation has been created by retail store amongst its customers. Even though there is no contractual arrangement between these two, even though there is no contract or legal foundation on the part of the retail store, still retail store will have to create a provision. Why? Because this is a constructive obligation on the part of the retail store in respect of these refunds, which may be required to be paid. Okay, yeah. Meena is saying yes. This will require provision. Very good. Namita is saying provision should be created. And same is the response from Pranav. Okay. Okay, so moving on to illustration number 4 now. X Limited has entered into an agreement with its selling agent Y, in accordance with which X Limited has to pay base percentage of commission on export sales, and additional commission is to be paid if export incentives are received. As per the accounting policy of X, it recognizes export incentives when actually realized on account of uncertainty in realizing such incentives. Export incentives have not been received for the year X1, X2. However, X Limited is hopeful of receiving the export incentives in the year X2, X3. Should X Limited provide for both base commission and the additional commission in the given scenario? Simple, easy to do. Yeah. So this one again, I'm marking for a wrong number. Illustrations number 3 and 4 are here. Okay, so now I'm moving on to page number 9.102. So there's a flow chart which you can see. I would say mark it for your revision. Please remember that at the time of examination, you will not be able to read this entire stuff. You will need summaries. Yeah. So either you can create your short notes. You will also get a presentation for short notes as around all of these things which I've been discussing with you. But these type of flow charts can really help you at the time of revision, which you can just quickly flip through and through which you are able to revise. So please mark this. It's a very beautiful flow chart which brings out most of the aspects that we have discussed so far. Okay, yeah. So now I'll move further on to the contingent liabilities. Please also remember the fact that so far we have not discussed the basis of creation of provision, the basis of measurement of provision. That is yet to be discussed. We'll come back to that part also. But before I get on to that, I think it will now be appropriate for us to pick up two things: provision and contingent liability, and also to differentiate between these two. Okay. So there's a concept which you might have heard, which is called as PPR analysis. PPR analysis. This is something which you need to apply, and basis which you will be able to understand what is provision, what is contingent liability, and in what situation all of these are required to be applied. Okay. So let's understand this. PPR means probable, possible, remote. Okay. Probable, possible, remote. PPR. What is probable? Probable means something which has more than 50% chances of occurrence. Means it's greater than 50%. Now, what is this greater than 50%? It's not defined anywhere in the standard. This is subjective in nature. 60% can be probable, 70% can be probable, 90% can be probable, 95% can be. This is something which is based on judgment. What is possible? Possible means which has occurrence chance of 50%. Means when it's 50-50, we are not sure as to what will be the outcome. That is called as possible. Third is remote. Remote means wherein the outcome or the chances of outcome is less than 50%. Now here again, what is less than 50% is not defined. Less than 50% can be 5%, less than 50% can be 35%, or it can be 49%. Practically, it's very difficult to put down this analysis in terms of numbers like this. But still, for the purposes of our understanding, we need to have some mechanism. And that's why we use this mechanism for getting into this understanding. So let's bring in one example over here through which we will try to understand what is this probable, possible, remote. Because I'm sure even now you won't get you won't have received, or you won't have got much clarity about this period. Say for example, there's a litigation against the company. There's a litigation against the company. And something which is very, very common, let's suppose there's a tax litigation going on. Tax department has raised the demand against the company, say for rupees 5 crores. Tax department has raised the demand of rupees 5 crores against the company, which is under litigation. Okay. Now, if we say that the chances of losing the case are more than 50%, then what do we call it as? Probable. And in case it is probable, then the liability or the provision, the moment we say it's probable, then the liability or the provision is required to be recognized. So in this case, provision is recognized. Because we are talking in the context of provisions, that's why I'm using the term provision. So I'm saying the moment we are crossing 50% threshold, we are saying the chances are high that the company will lose the case, then the liability should be recorded. Provision should be recorded in the books. Or if we say that the chances of company losing the case are not clear, okay, means it's 50-50. There's no clarity whether the company will lose the case or win the case. It's 50-50. It cannot be said as to what will be the outcome. It's not sure. So we are into 50-50 situation. So what is the situation we are into? This 50-50. Whenever we are into a situation of 50-50, what do? We don't recognize in the books. Instead, what do? We will put it down as a contingent liability. Or you can say that will be nothing but a contingent liability. That will be called as a contingent liability. So this is something which we call as contingent liability, which is contingent in nature, whose outcome is not known. And contingent liability is not recognized. It's not measured. It's only disclosed. It is only disclosed in the financial statements. Please understand. This one is recognized, but this one is only disclosed. The moment you recognize, it becomes a provision or a liability. But if you are not recognizing it, then it is only a contingent liability. Okay? Yeah? Third scenario. Let's suppose if the company is advised that the chances of losing the case are remote. Means the company is going to win the case. Company is sure that they will win the case. They are confident. Means the chances of losing the case are less than 50%. As I told you, these percentages are not defined. When I say less than 50%, it's judgmental in nature. We have to assess what do we call as less than 50%, in which bracket we should remain when we are assessing this to be less than 50%. But the moment we say that the chances of losing the case are remote, then can we recognize, can we record a contingent liability No. So what do we call it as? Nothing will be done. In this situation, nothing will be done. No accounting will be required to be done as against that litigation. Means nothing will be recognized in the financial statements, nothing will be disclosed in the financial statements. And you could be thinking, sir, even a note will not be given in the financial statements. Yes, in the financial statements, we don't even give a note. Nothing will be required because it's a report. Okay, yeah. So it's completely out of the financial statements. Nothing is required to be done in this manner. Alright, yeah. So with this, what we have tried to understand is, first of all, what is a contingent liability and when do we disclose a contingent liability? Secondly, how is this contingent liability different from a promotion? Okay, clear? So any questions, any doubts that you have on this, please let me. Then we'll move further on this quickly. Any questions, any doubts that you may have on this, please let me know. Then we'll move further on this one. Any questions, any doubts from your side? Are you all clear on this? This is a very, very common principle which is applied by the entities when they prepare their financial statements. And very popularly, this is called as PPR analysis. Auditors use this. When they are carrying out the audit, they will also be assessing the similar sort of things. Now, the same thing is required to be done for accounting. Cheers, clear on this? Any doubts, any questions? Then we'll move further on this. Shishni is saying, can we say that PPR analysis is not mentioned in the standard? It depends on judgment of the entity. No. So this term PPR is something which I have used for all of it. But this entire concept is given in the standard itself. This entire concept, I have not created this concept. This concept is there in the standard. Maybe if you just search these three letters, PPR, you may not get it. But you will get probable, you will get possible, you will get remote. All of these things exist in the standard only. Okay. But yes, this is for sure. The judgment has to be applied in all of these three cases. You can't just go by the percentages. For example, if you talk about any litigation, be it related to, say, tax or be it related to any matter, today, if you go to any lawyer, any tax consultant or any consultant, if you ask them for the percentages, let's suppose you are the entity and you will go to any consultant, you will tell them, for accounting purposes, we need this percentage. Can you give us the percentage? Mostly you'll see no. Yeah. So these percentages are only for the purposes of our understanding the concept. But a lot of judgment is required in analysis all of these points. That's why all of these aspects related to contingent liability provisions take a lot of time by the management when these are finalized. And these are very, very important areas as far as financial statements of any entity is concerned. Okay. Okay, so I'll move further. I'm just hoping you're clear on this. Okay, so before moving further onto this measurement of provision, all of these criteria, and because we have touched upon the principles of contingent liability, I'll also touch upon another term which is very rarely seen in the financial statements but is very important, and that is contingent assets. Very much online with the principles we have discussed related to contingent liability. I am receiving some queries now. Navita is asking contingent liabilities to be recognized when 50% chances are there, so it cannot be, so it's not possible to calculate exactly. So when is the provision? So when provision to be made? As I told you, this is very, very judgmental in nature. But for your purposes, you don't worry. In the examination, you won't be required to apply judgment. You will be given complete facts, basis which you will be required to create a provision. All of the examples that we have discussed today, I'm sure there was no judgment applied in that. Yeah? Everywhere we were clear when the provision should be made and how. But in the practical world, when you go, or maybe most of you during your articles, you would have seen that a lot of judgment is applied in this case. Okay. Clear? Yeah? Okay, so now moving on to contingent assets. So what do we mean by contingent assets? These assets arise from unplanned or unexpected events. Again, something which is contingent in nature, and because of which inflow will take place. Now, what is the definition of an asset? Let's go back to the definition of asset. I'm not talking about contingent asset. What is the definition of an asset? Inflow which will result to an entity, correct? Or you can say economic benefits that will result to an entity as a result of past events. Now, if there is uncertainty which is attached to this, if we attach uncertainty to that, means we don't know whether this will take place or not. Please remember that the uncertainty over here is different from what we discussed in case of provision. In case of provision, we were saying that the timing and the amount were unknown as to when it will take place. But that had to take place. But now we are talking about uncertainty, whether it would take place or not. Something we discussed in case of contingent liability. Whether it would take place or not, whether it would arise or not. That sort of uncertainty, when that arises in relation to any inflow of resources that we are analyzing, that becomes contingent asset. Contingent asset, similar to what we see in case of contingent liabilities, are not recognized. Those are not recognized. Those are only disclosed in the financial statements. Those are only disclosed in the financial statements. And this can be best understood with the help of this example. So if you can move on to illustration number 5 on page number 9.10. Through this illustration, we will try to get some more clarity around contingent assets, which is also talking about the definition of asset, the resources which an entity will get as a result of past. Okay, moving on to illustration number 5, please. And this is very, very important. In the exam, if some of the things have to be picked up from this standard, I would say that should either be the PPR analysis or that should be the contingent asset. That is how I would look at this entire standard. Because in this standard, these two things are most important. Contingent asset is not something which is very, very important, but because its understanding is difficult and generally there's lack of clarity in terms of its understanding, so that's why this becomes important for examinations. Okay. X Sugars Limited has entered into a sale contract of rupees 3 crore with Y Chocolates Limited for supply of sugar during X1, X2. So there will be a supply of sugar during X1, X2. As per the contract, delivery is to be made within 2 months from the date of the contract. In case of failure to deliver, X Limited has to pay a compensation of 30 lakhs to Y. During the transit, vehicle carrying the sugar met accident and X lost the entire concern. It is, however, insured. According to the report of the surveyor, amount is collectible subject to deductible clause, that is 15% of the claim in the insurance policy. The cost of the goods lost was 2.5 crore. So the goods lost were 2.5 crore. 2.5 crore worth of goods were lost. Before the financial year end, X Limited received informal information from the insurance company that their claim has been processed and the payment had been dispatched for 85% of the claim amount, because 85% is the claim amount they will get. Meanwhile, Y has made demand of 30 lakhs. Y is saying you couldn't complete the contract on time, 2 months was the time, so you are liable to pay penalty of 30 lakhs. What provision or disclosure would X need to make at the year end? Is we are talking about X1, X2 on 31st March X2. So you can see in the financial statement of X for the financial year ended 31st March X2, how should the accounting be done? If you have any thoughts on this, you may let me know. Any thoughts on this? Please let me know. I'll wait for response. Now the question is not asking you for contingent asset, contingent liability, recognition of provision, the recognition of liability. The question is simply asking you for accounting treatment. Let's assume that's the question in the exam. What should be the accounting treatment? Then how will you answer it? Okay, because in the exam, you should not always expect sort of straight question. Maybe the examiner wants to test you on that aspect also. So accordingly, you should try to prepare. Yes, quickly. Now in this case, okay, I am moving on to the answer now. In this case, there are two aspects. There are two things which I ignore as I clear. 85% of the claim amount. Number one, correct? One is 85% of the claim amount. That means 85% into 2.5 crore. That means 2 crore 12 lakh 50,000. This is one. Second aspect is demand by 30 lakhs demand by Y. Kalyani is saying 30 lakhs compensation should be provided and disclosure should be given for this insurance receipt. Shop is saying disclosure should be given, but general answers will not work. Shop. You need to be specific. Meena is saying inflow is sure as around the insurance claim, so we'll recognize contingent asset and also claim. Please remember the terms that you use in the exam. Also, you can make a mistake. Contingent assets are not recognized. Contingent assets are only disclosed. The moment you recognize it, will not remain contingent. Vijay is saying 2.125 crore is a contingent asset which needs to be disclosed. Okay, so let's go by 30 lakhs. Now 30 lakhs is what? There's a past event for this. Failure to deliver to Y. That's the past event. Present obligation has arisen? Yes, to pay the penalty. Amount is also something which can be estimated, 30 lakhs. So this 30 lakhs should be provided. This will be recorded, this will be recognized in the financial statements. As around this 2.12 crore 12 lakh 50,000. Yeah. This claim is approved. This claim is approved. And because this claim is approved, this is not yet received. So what does it say? They have received informal information. The information is not formal. If the information will become formal, they will receive the approval from the insurance company. Then this amount will have to be recorded in the financial statement. But so far, it's only informally the company has heard. Company has informally heard. That means they are confident. There are good chances of getting this, but uncertainty is attached. They will receive or not. It's not something which is known till the time it's formally announced. So that's why. What does it become? It becomes contingent and which needs to be disclosed. Which needs to be disclosed in the financial statements. Kanika is saying provision of 30 lakhs and disclosure of 3 crore. I think it's typing mistake, Kanika. Disclosure is 2.12 crores. Yes? Yeah, and that is absolutely correct. That is absolutely correct. Okay. Then Shekhar is saying future economic benefit is there, past event is there, insurance claim is also there. So it's a contingent asset. See, all of you have been talking about contingent asset. Why? Because currently we are in the mode of discussing contingent asset. In the exam, this may confuse you. And what will be the point of confusion, or what should be the point of confusion? In fact, that should be the point of confusion to all of you, which I am wondering nobody has been asking me. That instead of contingent asset, why should this not become an asset?
Why should this not get recorded in the financial statements? Just because we are reading Ind AS 37 doesn't mean that all of these type of transactions will not get recorded, they will only get disclosed. Yeah, which is not correct. Yeah. Please remember the terms which are used, facts which are given in the question. Question says X Limited received informal information. Because this communication is informal and they know that they are going to receive it through that informal communication, that's why they are recognizing this contingent asset. Let's suppose if they won't have received this informal communication, then even this contingent asset won't be disclosed. And the moment this informal communication becomes formal, this contingent asset will get recognized as an asset. Okay, so I just try to create situations for your understanding. In the given scenario, if the informal communication doesn't exist, only a claim has been given. So can we give disclosure of contingent asset? No. Currently, we have this informal communication. That's why we are giving disclosure of contingent asset. The moment this informal changes to formal, this contingent asset will change to NS. Yeah, Kanika is saying uncertainty की वजह से it's not an asset. Very good. Shelka is saying because currently there is no control of that. Great. It's good that you have been analyzing all of these aspects. So those are the most important things to be looked at in the exam also. Okay. Yeah, that's the most important aspect which you need to consider in the exam. Now quickly, because we are running towards the end of the session, so I'll just pick up question. And this is something which I am trying to pick up from test your knowledge section. It's an easy one, but I would suggest all of you to please answer this rather than just discussing this. I think Vijay have answered this. If there is a receipt, so the moment you receive, obviously this is an asset. Okay. Kalyani has also given the reason. Great. Okay. So I'm moving on to this question number 1 on page number 9.126. Question number 1. X is operating in telecom industry. During the financial year X1, X2, income tax authorities sent a scrutiny assessment notice under section 143(2) of Income Tax Act 1961 in respect to return filed under section 139 of this act for the previous year X0, X1 and initiated assessment proceedings on account of deduction claimed by the company, which in the view of authorities was inadmissible. During the financial year X1, X2 itself, assessment proceedings were completed and the assessing officer did not allow the deduction and raised the demand of rupees 1 crore against the company. The company contested such levy and filed an appeal with the appellate authority. At the end of the financial year X1, X2, appeal had not been heard Company is not confident whether the company would win the appeal. However, the company was advised by its legal counsel that on a similar matter, two appellate authorities of different jurisdictions had given conflicting judgments, one in favor of the assessee and second one against the assessee. The legal counsel further stated it had more than 50% chances of winning the appeal. Okay. Please advise how the company should account for these transactions in the financial year X1, X2. Clear? Yeah. So quickly, over to you. How do you think these transactions should be recorded quickly? Yes, quickly, over to you. Kanika is saying it's 50-50, so it should be a contingent plan. What about others? Quickly. I'm hoping you have understood the facts. Facts are easy to understand. Yeah? You need to assess. And Shelka is saying recognize the provision because there's more than 50% chance. Okay? Praveen is saying 50% chance of winning, so contingent plan. The moment you say 50% chance of winning, you're saying it's 50-50. That's why you're saying contingent liability. Yeah? Okay. Kanika is asking, am I right? I'll get on to the solution. Huh? Let's hear out from others also. Okay. Radha is saying provision should be recognized as outflows probable. Means there are chances of losing. Yeah? Okay. Vijay is saying more than 50% chances of winning. So nothing is required for them. Okay, great. What about others? What about others? Okay. Kalyani is saying to recognize the provisional liability in books, but disclose that company has filed. Okay. Ashok is saying it should be a contingent liability. It should be a contingent liability. Okay, so let's understand the facts and let's try to analyze it. In the given case, if you have to analyze these facts, company is not confident whether it would win the appeal. By taking into account the opinion of the legal counsel, it's not sure whether the company would win the appeal. On the basis of such evidence, it's more likely than not that a present obligation exists at the end of the reporting period. Correct? Therefore, in the given situation, what should the company do? The moment we say it's more likely than not means more than 50% chances of losing the case. And the moment we say it's more than 50% chances of losing the case, what will it become? It will become a provision. Yeah? Which has to be recognized in the financial statements. Meena is saying, I guess we need to create a provision and the chances are more than 50%. That's correct. The moment you say chances are more than 50%, which is also called as more likely than not. Or you can say more likely than not. Yeah. Okay. Here, in such a situation, what do you do? In such a situation, what do you do? Create a provision. Easy to understand? Yes or no? So what I'm trying to do is, I think, basis this, you can also mark question number 2 for your homework. In the homework, please add one more question. Couple of illustrations I have given you. Question number 2 on page number 9.1. Yeah, this one also should be added to your homework. All right. Yeah, clear on this? Okay, so with this, we can just end our discussion over here for today. And before we wrap up our session for today, quickly, if you have any questions, any doubts related to anything we have covered so far, please let me know. Please ask me your queries if any. Any questions, any doubts, please let me know. If I have missed out on any of your queries, please let me know. Mohammed is asking, so winning the appeal is more than 50% chance. Therefore, losing is less than 50%. Then it will be contingent, right? So you can look at it either way. So when do you create a provision? When the chances of losing are more than 50%. Okay. So if you say chances of winning are more than 50%, then it will not be creation of provision. Then it will become remote. Yeah. So depending on the terms that you are analyzing in your mind, you need to conclude it. Namita is saying more than 50% chances of winning the appeal. So why we are considering it as chances of not winning? No. So if we look at the facts of the question, it's about chances of losing. It's not about chances of winning. Maybe you can just revisit the question. Okay, no problem. Kanika saying I didn't read the last line of more than 50% chance. No problem. You can just go through it once again. Any questions, any doubts other than this, if you have on this, please let me know. Kanika, as of now, nothing is clear on that aspect. And I'm not sure why you're picking up this one, because maybe you might have attended this earlier. Is it? But I'm not sure about it at this point of time. Meena is saying, but in the question, it's so what I'll do is maybe we can just pick up this question once again. So if you have any sort of confusion in terms of these percentages, etc., in the next session when we start, I'll pick up this question once again for you. Don't worry. All right. Any more doubts in case you have on this, please let me know. Any questions, any queries? No? Done? All right, great. So then I will just end this session over here. Shelka is saying, in case of dismantling, we create a provision only due to uncertainty of amount. Yes. In case of dismantling, at times there could also be uncertainty as around timing. But in case there is no uncertainty around timing, uncertainty around amount will always be there. Okay. I think you have some confusion on this question. I'll just look at it. I'll revisit this one and we can then discuss it again in the next session. All right, clear? Okay, perfect. So with this, we can just end our session over here
Thanks to all of you for your wonderful participation in the session and for your time today. Thanks all of you. I would just request all of you to please revise this before we meet next, so that in the next session we can just continue with all of these understandings that we have. So in the next session we'll wrap up this topic and hopefully we'll also start with a new topic. Thanks all of you. Thanks for your time. Thanks very much.